Welcome to Accounting 201, Financial Accounting at Kapiolani Community College. In this video, we'll take a look at Chapter 9, which deals with property, plant, and equipment, plant assets, fixed assets, or items commonly referred to as capital expenditures. What are those? Those are anything, the dollar amount of which we've paid in cash, assumed a liability for, or traded uh, and the value is based on any one of those three items for acquiring or obtaining long-lived or fixed plant assets. Those are things that have a useful life of several years or more, say minimum 3. And any other material, ordinary, necessary expenditure associated with placing that asset in service or upgrading it or extending its useful life. So material means it's large enough to bother with. Ordinary and necessary means the kind of cost you would expect to have. Now, what is associated with placing the asset in service? That means installing it or getting it ready for use. Upgrading it would be improving its function, and extending its useful life is referred to as renewing or refurbishing or refurbishment. Revenue expenditures are what your book calls repairs and maintenance. They mean that they're counted as an expense on the income statement against your revenue in determining your net income. What are they? Well, anything that are repairs or expected periodic and relatively not that huge type of items that you can't really consider an addition, an improvement, or a renewal. So why would I bother to distinguish between expenses and assets? Well, if you debit repairs and maintenance expense, then this period your net income will drop immediately. However, if you debit an asset account, then you'll have no immediate effect on net income, and there'll be none until you actually do depreciation on that new quote-unquote asset. So as you can imagine, there's a fair amount of devilment which goes on between deciding whether something is an expense or an asset. Several terms that are easily confused and tough to work with if you don't have them straight are going to be covered next. First one is book value. Book value is your cost minus your accumulated depreciation. Accumulated depreciation is all the depreciation you've counted since you bought that asset. So we'll typically see it showing on the balance sheet in the property, plant, and equipment section, not current, as the cost of whatever it is, equipment, buildings, vehicles, etc., less accumulated depreciation. And that'll be in like a middle sort of a column, and they'll kick over into the main dollar column, what's called the book value. They don't refer to it as book value. You'll just see the number over there. Now, where will you find it? On your balance sheet in property, plant, and equipment, or fixed asset, or plant and equipment, or any other variety of things that sound kind of like that in the total column. Now, where can you use it? When you're doing a special kind of depreciation called double declining balance depreciation, and whenever you're calculating a gain or loss on a sale or trade-in of plant assets. Other terms that sound like that looks kind of like it, right? Cost minus something. Cost minus salvage value, or what we think the asset will be worth when we're done using it, is what's called depreciable cost. Other terms for salvage value, residual value or resale value. In other words, our current estimate now of what we think the value of the asset will be when we're done using it. Fair market value is what an asset is worth on the open market whenever it is you decide to get the fair market value. So it could be what it's worth now, could be what we think it's worth when we're done using it, which would then end up being the same thing as the residual value. There are three depreciation methods you'll be responsible for, and typically only straight line depreciation is considered in accordance with generally accepted accounting principles or GAAP. However, if you can make a case for it, you can use these other two methods that we're going to go over. Let's assume, for illustration purposes, that we have an asset, say equipment, that costs $24,000, has an expected useful life of 5 years, and a salvage value expectation of $2,000. Under the straight line method, we'll get the annual depreciation by taking the cost minus the salvage value and dividing that by its useful life in years. That'll give us the annual depreciation. Say 24,000 minus 2,000 salvage value will be our depreciable cost, divided by 5 years of useful life will give us $4,400 of depreciation expense per year. And that'll accumulate at the rate of $4,400 per year. So at the end of year one, accumulated depreciation will be 4,400. End of year 2, accumulated depreciation will be 8,800. End of year 3, accumulated depreciation will be $13,200, and so on. How do you do depreciation monthly? Well, you can either take the annual and divide by 12, or you can straight up do it by converting the number of years into months. In this case, that would be 60 months, and we get a number which is kind of a repeating decimal, but that would give you your monthly depreciation. Double declining balance method, probably the most complex method. You have several steps you have to go through. First, you have to get the straight line rate, which is 100% divided by your useful life in years. So in our case here, that's 100% divided by 5, or 20% per year. But then we have to double it because it's the, hey, double declining balance method. So take that 20% and double it, and you'll get 40%. Then you set up a table, which I have one more heading that the table doesn't have, and use your double declining balance rate and multiply it by whatever your latest book value is. Don't confuse it with depreciable cost. The salvage value doesn't enter into this calculation at all until the very last year. So do not subtract salvage value for DDB. So in period 0, our asset had a cost to us of 24,000. We haven't done any depreciation, so accumulated 0. So 24,000 minus 0 equals 24,000. In period 1, where we're going to do our first year of depreciation, that 24,000 times my DDB rate will give me 9,600 depreciation expense. My original cost was 24. My accumulated is 96, so my remaining book value is dropped to 14,400. It's dropped by 9,600. In period 2, I'll take 14,400 times 40%, multiply it, get 5,760. Accumulated will go up by 5,760, and book value will now be 24,000 minus 15,360, or 8,640, a drop of 5,760. Take a minute and compute for yourself, to see if you can do it, the depreciation for period 3 and period 4. So pause this video and give it a shot. Okay, assuming you pause the video or not, let's go ahead and compute period 3 and period 4. And we have to do a special procedure for period 5. Because our salvage value is $2,000, we don't want our book value to ever dip below that. The idea being that if the asset is worth $2,000 at the end of the period, you just sell it for the $2,000. You have that remaining in the book value. You got no gain, you got no loss, and everything just kind of like washes and it disappears, with leaving no residual gain or loss. However, it typically doesn't work out that way, but anyhow, that's the way we do the table. So we'll want a book value to end up being no less than 2,000, which means our accumulated depreciation can't be more than 22,000, and original cost never changes. So we have to back into the depreciation expense not by multiplication, but by subtraction. And so we get $1,110 depreciation. Now, partial period depreciation is kind of tricky. Straight line, not bad, because you can use your monthly amount, or you can take some annual amount that you get and take a time a fraction of the period. Usually safest to do something in the neighborhood of like 3/12 times the annual depreciation. That helps a bunch, and then you can't accidentally mess up with your fractions. Or 7/7 times 12 for 7 months depreciation. Excuse me, 7/12 over 12 for 7 months depreciation. Yeah. However, with declining balance, it's quite a bit trickier. And the reason why is because you need to actually modify your table at the beginning of the period. So if we were going to buy this same asset, useful life 5 years, salvage value $2,000, and I bought it 3 months into the year, then my depreciation expense for this period would be my book value, 24,000 as of period 0, times my straight line rate, divided 100% divided by 5 years, times 2, so that's doubled, times 3/12 of a year. And I still need to do, though, at the last period, what's necessary to keep my book value from dropping below $2,000. If I were to go ahead and do the regular book value times DDB times fraction of the year, I'd get that. And I don't want to do that because that would make my book value go below 0. So I don't do that. I do the plug the number to arrive at a book value of 2,000 or my salvage value. Now, third method is actually not too tough. It's a lot like weighted average inventory. So this is called the units of output, also known as units of production, also known as units of output or units of activity. And in this situation, let's assume that we think the entire useful life of this asset will be 176,000 units of activity, miles, parts stamped by our stamping machine, pieces of plastic extruded in our plastic extrusion machine, cloth woven on our, yards of cloth woven on our weaving machine or knitting machine, whatever it is. So you do depreciation per unit based on your expected activity, and that just tells you how much your depreciation is for one unit of activity. So one item manufactured, 1 mile driven, 1 hour of flight time, whatever your activity base is. Cost minus salvage value, hopefully you remember that's depreciable cost. Divide that by expected units of activity over the asset's life, and you'll get the depreciation for one unit of activity. In our case, 24,000 cost minus 2,000 salvage value, and our expected units over the entire useful life, 176,000, means our depreciation for one unit of activity should be 12.5 cents or $0.125. How do you get annual depreciation? You need to know the depreciation for that period of time you're talking about. So this could be a month, could be a year, could be however long, but we need to do the depreciation for it, but we need to know the actual units of activity. In this case, assuming it's 50,000 units of activity, 50,000 times my 0.125 will give me my depreciation for this period, $6,250. Next item, getting rid of plant assets has to do with what we do at the end of the asset's life, or in the case where we no longer need it, or when we are just plain old disposing of it for one reason or another. So what is a disposition or a disposal when you're getting rid of the asset? We'll look at scrapping and sale. Although a trade-in is a possibility, that's more complex than what we need to cover in this intro to financial accounting class. So a common thing you'll find in all your journal entries for getting rid of or disposing of your plant assets is you typically are going to be asked to update or calculate the balance of your accumulated depreciation account. And to do that, you'll typically get accumulated depreciation at the beginning of the year, and you may be given depreciation expense for a current year, or you may have to calculate it yourself. And then it'll require you to make an adjusting journal entry, debit depreciation expense, credit accumulated depreciation. And then you need to post that accumulated depreciation to the accumulated depreciation account so that you can get your latest or your final accumulated depreciation as of the date of disposition. And several ways you can do it. You can take number of years times your straight line amount, and then so 3.5 years or 2.25 years or whatever it is, and or you can look it up at a DDB table, or you can do all your units of activity so far times the depreciation per unit, or whatever's needed to get the accumulated depreciation as of the date of disposition. And then every journal entry for getting rid of the plant asset, you always have to remember, because you're not going to remember unless you do so consciously, to debit accumulated depreciation. Because not only are you getting rid of the asset by crediting out that asset account, you're getting rid of its related accumulated depreciation by debiting out that contra asset account. So every journal entry will have debit to accumulated depreciation, a credit to the asset. Now, the difference between the asset and accumulated depreciation, you might remember, is what's called book value. So you need to know book value when you're disposing of a plant asset, because you'll use that in calculating whether you've had a gain or a loss. If you just scrap it, then you'll have a loss equal to whatever your book value was. However, if you sell it, then you'll take the selling price minus the book value, and that'll tell you whether you've had a gain or loss. In the case of an asset, when you're scrapping it, you could think of it as kind of like a zero selling price minus some kind of book value equals a loss, because basically you either have a loss or no loss, but never a gain on scrapping. We have a worksheet that goes over dispositions of plant assets, and that's this guy here. In this one, you look at the possibility of scrapping the plant asset, and you have to go through the steps of figuring out how much your accumulated depreciation is, getting rid of the accumulated depreciation as well as the asset's cost. And at that same time, you can figure out what is my book value. And then in the case of a scrapping, you just take the book value and debit an account called loss on disposition of fixed asset or plant assets. However, when you have a sale for cash, you still have the same process of figuring out your accumulated depreciation, determining the book value based on the difference between that and the asset's cost, and then you have some actual selling price from which you subtract that book value you computed to figure out whether you had a gain if positive or a loss if negative. If it's a gain, then you'll credit an account called gain on disposition of plant assets, and if it's a loss, you'll debit an account called loss on disposition of plant or fixed assets. And again, credit the asset like you were going to up above. The last thing about a sale for cash is you have to insert the cash amount, which is whatever it was we sold it for usually. So you'll have a balanced journal entry with the cash amount, accumulated depreciation, a gain credit or a loss debit on disposition of your plant asset, and at last a credit for the asset's cost. Several kinds of plant assets property, plant, and equipment we want to talk about. Natural resources, of which we have basically nothing in Hawaii except our friendly people, lovely beaches, and great sun. However, other states and countries have things like gold, silver, oil, coal, other items that they can sell. So when you pay a certain amount for land that contains these natural resources or expected amount of natural resources, you try to determine how much of those total resources you think you'll ever be able to fully extract from the land. And then you divide your cost essentially by that to use for making a depletion entry every time you take out X units of that resource. And your depletion entry will be a debit to depletion expense, which is just like depreciation, except it's for natural resources. And then you'll credit an account called accumulated depreciation. If, for example, however, you purchase a copyright, a patent, or something like that that has a cost, and you're able to make money with that over time, typically those things will expire through time, but there may be other factors that influence how they expire, like maybe you have exclusive distribution rights for up to a certain number of units of a product or something like that. You'll make an amortization entry. Amortization is just like depreciation, except you call it amortization expense instead of depreciation or depletion. And second thing, you do not credit accumulated amortization. You credit the intangible asset itself directly. Last thing, a little bit of financial statement analysis, something called asset turnover. Asset turnover is considered a profitability ratio. We look at how efficient the company is at managing its assets. Now, the higher the turnover of the assets, that generally indicates the more efficient the management of those assets. So it kind of tells you how many dollars of sales have been generated for each dollar of your invested assets. And you can use this to compare your performance from year to year or to compare against your peers. In this case, I'm going to show we have net sales of 3 million and our average total assets of whatever they were at the end of the last year and whatever they are at the end of this year added together divided by 2, and we get a turnover of 5.7 times. This means on average we employ the assets that we own in order to generate sales about 5 to 6 times, almost 6 times per year, which may or may not be good depending on how well we did last year and how well we're doing among our peers. Hope this helps. Thanks for listening.